Okay, so when the daily time frame wants to start retracing, the lower time frame will change to bearish structure. That is what I was trying to tell you about market factors and then change of structure. Now, if you go to this now, if you go to around here in your 4 hours, so let's box that. Let me open up another chart. Let me open up another chart on XRP, Bitstamp, or Coinbase, USD, Coinbase. Okay. So okay. This guy doesn't have so many data, unfortunately. Okay, so let's change to Bitstamp. Let's take Bitstamp. Okay, so now when the market is wanting to sell from a lower time frame to a low from a higher time frame, the market is changing structure. What it actually means for the lower time frame is that it's possible retracements, right? And that means a counter trend trade. You want to sell possibly to know if you can catch the retracements, but it's a counter trend trade because your trend, what you're taking as a trade, is not in sync with the higher time frame trend. And because this move that is bearish move on the daily time frame, of course, would be just a series of candle on the weekly time frame, which is weekly retracements. I don't know if you get. So you look at this now. This is a weekly retracement, right? Came to the support, bought back. But if you box this now and go to the lower time frame, maybe 1 day, 4 hours, this is a clear, this is a clear bearish trend on the lower time frame because you see a clear break of structure for 1 day, which is calling for the weekly retracement. You also see a clear break of structure for 4 hours, which is calling for a daily retracement. So in essence, what is this trying to tell us? What it's trying to tell us is this, is that the market moves in turn. If you are expecting the day, which is your higher time frame, to start buying, then there should be a confirmation 4 hours. Because I presume that that was what you did yesterday when you said you went for 15 minutes to refine the entry and stuff like that. Remember, this was a whole sell trend, just retracement trend on the weekly time frame, right? Can you see that in this particular zone we marked out that there was this high, lower high, sorry, higher low, higher high, and then the market changed character, right? And then it pulled back into that premium zone here and then sold again, which is the confirmation that the daily wants to retrace. So oftentimes people can say that this market is bearish, while in essence the market, the big time frame, which is the big trend, is still bullish. So that's where top-down analysis comes into play. You start from your higher time frame and you work your way down to your lower time frame. I don't know if you get that. Now for this particular trade we took on, or rather I call that on XRP. This is what went wrong. Now, if you look at this particular trade now, this market is still bullish on the daily time frame. I don't know if you can see because these were the last structure points. This was the last higher low, right? And then higher high. And for this market to retrace, which is all these things you are seeing now, it's expected to come maybe 50%, maybe 60% of your Fibonacci retracement to somewhere around the zone here, below all these points, right? Now, considering liquidity concept and all, which this actually at the moment is, an imbalance below this point. So this is a very strong area for the market to enter and buy from here. 1.4, 1.5 is a very strong area for the market to buy from. What are the telltale signs? I've already called a buy for myself on that zone, $1.4, 1.5. You will see another confirmation that I trade harmonic patterns. I don't know if you know that.
I know it, but I've not
Okay. So harmonic patterns, those are strong reversal signals on the market. So when they confluence or converge as my areas of interest, I know that okay, this is actually something nice. So this is a Gartley harmonic pattern. It's 0.786 of the whole swing, right? It tells me that okay, this is a very good place that I'm looking to buy. So I was interested in catching the retracement sell. So I went down to 4 hours and looked at the trend in 4 hours. What can we see in the 4 hour trend? You can see that for the 4 hour trend, it's clearly bearish, like clearly bearish, right? This was the higher high, higher low. It broke structure here, and then did all this funny structure within structure, pulled back, broke again here. So this is swing points. This is another swing points, right? These are two swing points. More like the top range. And then your down range here, right? So all these things are happening within this swing low. That's if you mark your structure points, where did your break of structure happen? Break of structure happened. That's the last swing points or the last character change in this particular trend. Remember, the daily see what's bullish. So what we are trying to work down, you see if you can catch the lower time frame retracements. Actually, you understand me now, right? So you have this break of structure here. The market is pulling back to the retracements, upper, top range, down range. You measure from your top range to your down range, anything in premium, which is above 50% of your Fibonacci retracement zone. And if you watch, the market already reacted from 618 of the Fibonacci retracement zone. Yeah, what are the things that are interesting about the 618 of the Fibonacci retracement zone? For mark further price action or further analysis, you can see that that point is the demand supply zone in the market. If you mark that like this is a good demand supply zone in the market, right? Now, market already reacted from here. Market reacted here, minor support here, resistance here, 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 right? Now, considering all this, you see that this is actually a very good area for you to expect the market to give you, in other words, reaction, right? So now, okay, the market has traded to that particular point, and you're looking for your risk to be very minimal, right? You don't want your risk to be so big that okay, excuse me, let me close this up. Stopping. Want to remove this thing, it's not coming. Okay, sorry, this is on. So now you want your stop loss to be very minimal. That is, you can't just enter at 618 because taking for me how I trade actually is a very good point. I don't know if you know what we call quarter points in the market. You know what quarter points are?
No.
So you don't know what quarter points are. Quarter points are whole numbers. They are whole number prices in the market, where the market are most likely to react from. If you start observing, you see that 200 level, the market, even if the market doesn't buy or sell from there, oftentimes it gives a very good reaction from whole numbers 80, 100, 60, 50, 10, 0.1, 0.2, stuff like that, right? So I'll be putting my camera off, okay?
Okay.
So these are quarter points in the market, and that was the reason behind me trading 2.395. I knew that 2.4 is possible, right? And I know that above 2.4 is still possible. Yeah, there are still things that happen around quarter points. If you have already observed with your experience, sometimes you may want to trade off your quarter point, maybe let's say $5. The market can come and do 4.98 or 4.97 something or 4.999, and it will not trigger you as 4 point at $5, right? I don't know if you've experienced that before.
Yes, I have. Yeah.
A lot. It happens a lot in the market. So now, instead of me exposing myself to that kind of opportunity where, okay, I have a good trade setup that I'm optimistic about, and expecting this to sell or buy, I can add 1 or 2 pips to that particular entry, depending on if it's a sell. If it is 2.5 that I want to sell, I can decide to sell at 2.48, which is the next quarter point. That is very, very good. If the stop loss will be minimal at that point. If it is not minimal, I can push 2.485 or 2.49, 2.492, 2.495. And you see, oftentimes the market could come and react from there. And then will not go so high into the next whole number that you're looking for. And you will be in your trade and you won't miss out on that. Sometimes it could come close to even that's with all your adjustments, it can come close and then miss your entry. So these are the reasons that I play those kind of numbers. I don't usually play whole numbers like that to avoid missing out on the trades. So for this particular guy, we've seen that this guy have traded to this place, but the risk that we could have gotten on this trade would be too high. That if you say you want to get 1 to 3 following our ratio, reward ratio, right, and our trade patterns, you will need the market to sell so high, which is probably here. How optimistic are you that the market can get to this particular point? It may be difficult. It may happen, but come on, it's not really that easy, right? So instead of exposing myself to that kind of, I'll say, okay, let me wait for a lower time frame entry. So lower time frame entry. This is 4 hour now, Nabi. So things like maybe 1 hour character change, 1 hour reversal, 1 hour trend. So going down to 1 hour, I spotted that the market had changed trend in 1 hour to the trend here, and it did that with a 1, 2, 3 drive pattern or ABCD pattern. 1, 2, 3 hit the point and then sold off. This is another reversal signal in the market, harmonic reversal signal in the market, which are very powerful. Now you can see that the market is bullish, higher high, higher low, higher high, higher low, higher high, right? Because that closed above these points, higher low, higher high. Then the market broke at these points here, pulled back, broke again, pulled back, broke again, pulled back, broke again. So now at this point now, I feel like, okay, there's a clear established 1 hour trend, right? But remember, we've not established at this point in time, we've not established a 4 hours break, because this is where we were at this right? I think somewhere around here. I haven't established a clear 4 hours break before this guy came back and then took us out, right? Because if the break had established all the way to this point, we will work with the 4 hour range, which will become this from this top and this top. And we want to enter anywhere within the 4 hour discount zone, sorry, premium zone, which is above 50% of your Fibonacci retracement zone. And your stop loss will be outside of here and not here that we placed this. I don't know if you get that now. So for this particular reason, the trade became a loss on the signals, on the patterns and strategy we trade. Nevertheless, remember, every other thing we did normally. We refined our entry at lower time frame to get a smaller stop loss, which is what you could have done even if you are trading daily time frame 4 hours. Yeah, this is the market forces and the need for risk management, because this market took us out and is selling, right? Which are those kind of things that, okay, your prediction was correct, the market is going your way. Yes, yeah, you can't always say what the market will do. So you call the trend right, but for some reason the market doesn't want you to ride with them. For that particular reason, this guy is a loss, took us out and is selling. Now you may wonder, okay, is it not okay to re-enter? And yeah, you can actually re-enter now, playing 15 minutes entry, right? If you are comfortable taking another risk on this, because 15 minutes is now very that's but yeah, there's one thing you always remember, right? One thing you always remember is that the higher the time frame, the stronger the signal. I don't know if you get. Considering the fact that this is a counter trend trade, right? It's always better to kind of take buy reversal trade or buy scalping or whatever. If you are scalping, it's better to always scalp in sync with the higher time frame trend. If there is a buy signal here now, I would have said it's better to take a buy signal than to call for a sell signal. Here, there's no buy signal that I'm actually seeing. So the market is actually clearly trying to retrace into 1.5, 1.40 because I'm optimistic that this market, will definitely take out this very low or at most come to 2.05 and react from there. So the only possible thing I will be doing is that I will be watching out for a new low to be made. That is for this low to be taken out, right? To establish a new 4 hours structure points, higher high, higher low. And then I will want to enter somewhere around the place we entered before 2.39, 2.4. Hopefully the market triggers us in. If it does, then the trade is gone. So that is that about this particular trade. Then I took a trade around on Solana. Okay, so Solana, what was that? Solana USDC, all right. This did not trigger us in. Now, this is the ultimate trade I have for Solana. I want to walk you over. I have in Solana all these cells. I was able to catch them, and then I rolled it with an interest towards this particular points here, and I was able to catch this as well. So, and I'm hoping to get this retracement now. So let me walk you over what Solana has been doing in the last couple of days. And that is why you don't need to FOMO. You need to always be patient. Trust what you are seeing in the markets. Now let's start with a daily time frame. I don't know. Do you know what is Wyckoff accumulation schematics?
I've heard of it.
Okay. So yeah, this particular box area. I remember what in the last video you watched. I spoke about trying to avoid ranges, right? This is a range where the markets had a range. Yeah, consolidation phase. You can actually see that the markets had over this time been trading within this box. It did not go over, it didn't go beyond. Yet, if you had marked your support resistance here, you could see that all these weeks were coming to trigger stop losses and then come back and consolidate into the zone. This is a very good place for you to use bots to trade this kind of things. Maybe the bot is buying for you in between here and selling at the top of here, selling at the top of here, buy for you in between here, something like that kind of a thing. It's a very good place. Consolidation is only good for bots to trade grid zones and stuff like that. So now I did this analysis here. I think the markup should still be somewhere. Yeah. And then this is what we call Wyckoff accumulation schematics. This is preliminary support. There's a support level here people are expecting the market to buy from. And when this happens, it happens at extreme price actions, where you know what price actions are, of course. You can see that these candles that sold are having momentum, right? So they sold hard to this support level here. Now, this rejection you see here, understanding price, did not happen because there were buyers in the markets. No, this rally you see here did not happen because there were buyers in the markets. Remember that if you short a market, right, for you to take your profits, it's buying. You are aware, right?
Yes, of course.
Yes, okay. So now, for people who had been shorting this particular pair, they know that this is the support level here, right? So when the market came to that zone, and it's also a whole number quarter point, 140. Now, people took profits from their short positions. And by taking profits, you are actually initiating what? Buy, right?
You bet.
So now the market will now show you what will have will call automatic rally. This action here did not happen by market forces. This is what we call automatic rally. Now, for someone that does not understand what is happening, the price action that is happening here, it might be like, okay, the market has formed an engulfing pattern. You show this, yeah, the market is bullish, and then you buy now, the market takes you out, right? This is the beginning of the Wyckoff accumulation schema. You won't be able to confirm this for me. I won't be able to confirm this until I see this part, which is almost the middle point of it, right? Because I'll be able to say, okay, this was the preliminary support, automatic rally, secondary test, sign of strength, secondary test, sign of strength, secondary test in phase, sign of strength, and then this is your spring action. If this spring action happens with this kind of candle, which is hammer or pin bar formation, whatever it happens with, that shows that there is a strong demand here. Because of course, all these things are stop losses that were triggered, right? That shows that there is strong demand here and gets a follow through. This one is tests. This what happened here is test of support. That's test of spring. If demand is here, this is the final test. And the very day I made this analysis, the market was somewhere around here. I danced it on my status. If this closes with a bullish candle here, that this 3 days bullish is a confirmation buy. Then after that, the market pulled back, showed a very good strength, came back here, which is the last point of support, traded above the zone, and then gave you what we call sign of a very good sign of strength. Now, this particular point here, you can mark this as these are zones of demand supply in the market, of course, right? Because these are the areas where the market had been reacting considerably, right? Now, the market had expanded. If you look at a weekly time frame now, see that all this is a weekly swing. All this is a weekly swing. You can see, right? And then if you put your Fibonacci retracement tool now and check out, this should fall at somewhere 50%. And interestingly, it's falling at a significant price level, 180, 200 zone, right? This is a quarter point. So by virtue of all these confluences, I'm thinking, okay, this should be an area where the market should actually show something, right? So the market sold, but of course, I would like to catch the sell, right? I would like to catch the sell if the sell starts. So how did I know that the sell have started? The market had been bullish, of course, right? And then suddenly the market closed below the higher low, right? Making a lower low. And then you see the trend, you see the trend, you see the trend, you see the trend now, right? Now there's a particular structure that the market played here that was actually confusing me, right? There's this now, if you look at this trend by virtue of this is still bearish, right? High.
Yes, because it doesn't.
This is higher high. This is higher low, right? By virtue of
Yeah,
whatever we are
yeah,
seeing here.
yeah.
Now, the market is bullish. The market played one interesting structure pattern here, and that is in areas like this when you feel like okay, you are confused in the trend the market is actually showing you or the structure points, you can use your line charts. Line charts show structure points better than graphs. Why? Because line chart only plots closing. Okay, line chart plots only closing. Maybe depending on if you actually reset it, because you can always reset it to your preferred, maybe open, close, maximum. But then on a default state, line chart could show what's closing. Now, and if you plot your line chart, if I open my line chart, there's something I can actually see here. I can see that there was a retracement here with that hammer that printed. The market did this, retraced, sold, and then it broke this structure here. So this is actually what? A bullish retracement. But it wasn't seen here on this chart. I don't know if you get now. So what happened here?
I get your point.
The market became bullish around there, but this guy did not show that. So the market pulled back, met resistance here, but it broke above this because the market initially, this very bearish candle here, experienced that automatically, came back, and then met another support that printed this very engulfing pattern here. Because we know that Hamas, of course, are bullish signal, which people may have traded as well, and then met another supply at this resistance zone here, and then we traded below that low. So for that particular reason, this guy came back, broke that resistance here, and became what? Bullish. So the trend became bullish, which now is bullish. But I will not buy this guy here because of what we've been able to identify that there's a range in the markets when you are defining the market structure, right? So this is the down range, right? For this particular pair now. This is the down range. Then this is the top range here, right? Because we've been able to identify the structure points. Where did the structure change? Structure change here, and this guy is bullish. And again, this guy is at the supply demand zone, right? It's actually at a significant supply demand zone, right? So yeah, can see what happened here, everything that's happening around here. So a reaction is expected of this guy here, definitely, and which you have been seeing because if you consider price action as well, this guy was having momentum to the bullish side. This guy had momentum. Immediately he came here, the momentum started dropping, and then switching slightly, looking like he's switching to bearish. Spinning up a bigger candle, but who knows what will happen now? And then probably that's the most of our retracement, right? So observing that the market has traded to this particular point, and it looks like a new higher high has been formed. What did I do? I went to 4 hours to check if I can catch a sell entry, right? So what did we see in 4 hours that prompted that trade call out? We can see clearly that there's been a break of structure in 4 hours. Can you see that? There was high, higher low, higher high, and then the market did was close below this previous higher low, which changed, marked the beginning of the change of what structure. And ordinarily, what this change of structure in 4 hours is actually telling me is that daily is retracing, and not that daily is bearish, right? Daily might have wanted to start retracing. And understanding this, I might say, okay, let me try to be in sync with this. I know if I can take the counter trend and sell to my point of interest around 193, 192 zone, right? So yeah, that was mark up everything, looking to enter at 217, but the market came to 216 points. Points what? 216.99, which is what we just discussed the last time, right? And then sold from there and have since to have left, right? So why will I not sell here? Why will I not sell here? Because when if I sell here, I have calculated my risk that I want to take my position and everything. Going to market execute, I don't know where the market can actually fill me in at, which can alter my risk, right? For that particular reasons, I do not do market execution, but I don't know where the markets will resist. And because what I do has a kind of precision to it, that is why I trade limit orders. I do not trade market execution because you know that there needs to be kind of confidence that okay, the market will definitely come to your price for you to be able to trade limit orders, right? So that is how this guy actually works, right? So it's only limit orders I do. If I miss it out, it's done. I could be able to do other things that I have to do for the day, set my limits, if the trade is triggered, come back, set my stop losses, set my take profit, and get on with my businesses. But to stay in the market and start doing market execution, I'm not comfortable. It doesn't work for me. I know it works for people, but it doesn't work for me. Considering the fact that if I do market execution, it is at the will of the exchange or the broker to fill you at any available price, right? Which you definitely alter your risk management, because you don't know the price they will fill you at. Just like you are doing auction purchase, highest bidder. So because you say buy for me at any available price or sell for me at any available price, you calculated your risk at 217. They can fill you in at 215. They can fill you in at 214. And because immediately they fill you in, you already have drawdown, right? And your risk will now be bigger than what you wanted to have initially. That's one of the drawdowns or the setbacks I feel and I have for market executions. Okay. So that's why I do not do market executions. Okay. That's that about this particular trade and subsequent other trades. So it comes with top to down analysis, start with a higher time frame, go down to lower time frame, go down to the lower time frame, and go down to the lower time frame. If the lower time frame start doing something like this, it could be that the upper time frame will follow suit later. Okay, there's something I saw on Bitcoin USD. Let me show you something on Bitcoin, BTC USD. I was watching this guy closely before the last sell that I took. Okay, yeah, this thing that this was actually a study. This markup was a study. Now look at what happened here. I think somewhere around here. Somewhere around here. Let's mark that up and then let's see. Somewhere around there. I think she should be somewhere around here. Okay, let's mark that up because I wanted to use that. This buy was a study actually. So now let's go to the daily. The daily had broken structure since. Okay, yes, I've been able to see that. Look at where the daily broke structure. The daily broke structure here. Sorry. Which is similar to what we are talking about on that. We spoke about and that was it Solana, right? The daily closed here, right? This is where the daily closed. This is where the daily closed below this lower low, right? Now, so but then when I went down to 4 hours, 4 hours is still bullish. You really had broken structure here, right? But then you can see that 4 hours is still bullish. So 4 hours came to break its own at these points. At these points, this is where 4 hours broke that close below this low at these points. So now in this kind of scenario, I was like, okay, if this guy is still bullish, it means that this is the structure point, right? So I should be expecting a buy somewhere here, right? So let's see the market buy here, and then I just say, okay, let's check out if the market will buy from here. And unfortunately, the market did not buy, right? Confirming that the daily time frame will always supersede the 4 hours time frame, and the 4 hour time frame will always supersede the 30 minutes, and just like that. Okay, now because the daily time frame and the 4 hours are now in sync, it gives me the stronger signal to say, okay, I should expect a sell. So where should I be expecting the sell from? Where should this sell come from? And then I marked, did analysis, right? Anything from this top to this down, the valid entry. Look at, you have your exit BCD pattern or your harmonic pattern still. The time will learn that you will be able to see it whenever it comes. All right. So these are strong data signs. The market. So yeah, this is for 4 hours. Now, the same thing that happened with XRP is what happened on this Bitcoin trade, because I think this Bitcoin trade hits that stop loss, right? Can you confirm with me?
I'm with you.
Yeah. I think this Bitcoin trade hit that stop loss or stop loss above this point. Yet the ideal stop loss for this trade is above this high. because this is the trading range you're having. But this is one of the flaws about taking trades with lower time frame, entry modifications, and blah blah blah, refining and all that. Right? When you take, you can't hold. It will be difficult for you to aim for higher time frame, take profits with lower time frame entry. Else, it's kind of a very precise entry. I don't know if you get me. Now, because
mm,
this trade reacted here, so they beat and then came back to respect this high, but it broke this high here. All right. Now, I'm of the opinion that this trade will still sell, right? And I'm expecting to see something from this trade. Now, it made high, low, high, right? So I expect this guy before the end of today or by tomorrow to close below this low, pull back, and then sell. So if that is done, this 4 hours entry around, that's a 98, 800, 98, 500, 98, 600 will be a valid entry. But I can't sell now because if I sell now, definitely I'll use this stop loss here, 102. That's still okay. You understand? But if you want to use stop loss here or anything like that, you wait for this point to break, close below this very point, which means the daily is bearish. Now the 4 hours is now bearish in sync with the daily. I don't know if you get now. Because for this daily that was
mm,
bearish, the daily was bearish, right?
mm,
And when this
mm,
4 hours started retracing, look at what happened. This is 4 hours trend. This. And then look at there's this break of structure here. It made a low, made a high, came back, broke structure, pulled back. Can you see that market became bullish in 4 hours? Came back, came back, came back. So if you want to take that lower time frame entry now, you wait for these 4 hours to happen. Because the lower the time frame, the less efficient I would say the signals are. The higher time frames will always control the order flow and the market trend. If the monthly is bearish, you can't just be thinking that the weekly is bullish. What's happening in the weekly is a monthly retracement, and once the retracement is completed, the market can still sync itself with the monthly order flow and then start going where the monthly is going. I don't know if you get me now. So that's basically
yeah,
about trends, order flow, and structures. So now, one thing I need you to do for me now is this. This will be an assignment. Okay. So I will need you to go to the assets you trade, right? That particular asset. I need you to do a top-down analysis starting with weekly. So you mark out the weekly time frame, what the weekly trend is, clearly mark it out. Let me show you something. Let's say for Bitcoin now, on the weekly time frame, Bitcoin is clearly bearish. It's not deviated. I don't know if you are seeing it, but the Bitcoin is clearly
yes.
bearish.
It has broken structure, and there's a change of character.
Here, right? This is where it happened. If you cannot see it, you open up your line charts. It's there. Okay.
Mm,
Now the weekly is bearish. So the daily is what's still bearish. Now there's something beautiful about these trees because I the trade I took here is more like okay, I won't say that this is where the market should react from per se, but I wanna bet on it. I don't want to miss out because I feel like the move that the daily or where the sell we go to is a big ride. Okay, it should sell all the way to at least 90K. So I'm expecting that it should come all the way to 85, 80K. That's my expectation for Bitcoin in the coming days. It may not happen soon, but yeah, I'm expecting that. There's possibility that it can start selling from here, and there's a possibility that it should still pull back all the way to this imbalance here. All right.
mm,
So,
mm,
and considering liquidity, there's already a lot of stop losses around this zone. so the market can actually capture all this and pull back all the way to this imbalance here and see that and there. Nevertheless, well, if that happens, that's one of the two scenarios. The market can decide to sell from here or can decide to come back here and sell from. But we know that the weekly is bearish and we expect the daily to become bearish. And if that happens, if I don't sell from here, I'm waiting for this place to happen. And this place happens, I'll miss out on that. So it depends on, am I comfortable with risking these particular points and still reach these particular points? That is where risk management and every other thing and your decision and how to manage your trade comes into play. So that's that about this guy. This guy starts selling from here. I expect it to close below these points, and then come all the way to these imbalances here and possibly reaccumulate from there, and then go. Okay, so that's that about this guy. I don't know if there's any question here. So now what I was saying rather before I digress is that I need you to go now to let's check Apple, Alphabet Incorporated, Nasdaq, weekly charts. So yeah, so I need you to do from weekly. Don't worry, don't use this one because their daily charts are not usually that neat. But still use it. Yeah, it's a learning curve. So now I need you to use Apple now. Start from weekly, mark the weekly trend for me, right? The weekly trend, that's the higher high, the higher low, where the break of structure happened. Then you mark the daily, you mark the 4 hours. If there are changes or subsequently retracements, pullbacks that happened, I also want you to mark that separately to outline, okay, this is what happened in the weekly, this is what happened in the daily, this is what happened in the daily, and let's know and see why the market is doing what it's doing now in the lower time frame. Okay, that's for Google. Then the next you should actually do should be Ethereum USD, Bitstamp, or let's use Coinbase. Okay, so you look at Ethereum. What is Ethereum looking like now? Is Ethereum bullish? Is it bearish? What's your opinion and why are you arriving at that opinion? All right. So now, two things for Ethereum for me, but I'll still need you to mark that out. This had been a strong demand supply zone in the past, right? So I expect the market to still come back and respect that. Nevertheless, the market had developed a new one, which is still in sync with this here. If you can see that, let me put this up on DC also. This is seeming to be where the market played off on the weekly time frame, right? So the weekly is still bullish because this is the I've given myself out. So just do this assignment, right? Mark out the trend, the lower, the higher high, higher low, weekly, daily, 4 hours, and send to me, and then indicate the trend as well with your direction path indicator. Indicates higher high, higher low, higher high, higher low, higher low, higher high. Okay, and if there's any place break of structure happened, just indicate all of them for Ethereum. So that's 2 now. So let's make it 3, and then any other one of your choice. Okay, so that's that. I don't know if you have any question.
No, first and foremost, does this system work with synthetic?
Yeah, work with synthetic. I trade synthetic indices. I do not trading now. I trade synthetic indices. Let me. Oh, it's not on this machine. Okay, so let's look at synthetic indices. Wait. Trading zero. Then okay, so which particular should we look at? Is it boom 300, volatility 75? Which one?
Let's do 75.
Okay, R75.
Yeah, yeah.
Okay, so this is 24 hours charts. Yeah, you know your MetaTrader, you can get weekly time frame on this. You aware, right?
Yes, I'm aware.
For if you sign in MetaTrader, your PC, you can get weekly time frame for $12. Now look at what can you see here? This guy was bearish here, right? Let's see where the change of structure happened. Zoom in. I hope you're aware that okay, it's been marked. I hope you're aware that break of structure is marked with close of candle and not tip of candle.
Yes, not the weak, body, the body.
Yeah, not the body, yeah. Okay. So now this is volatility 75 index, right? So you have lower low, lower high, and then lower low here, right? This is where the lower low happened because the market did not close here. It's pulled back and then closed here, created this structure within structure. And because it has played these zones here or these retracements here, there was like the market felt like there's no need for it to still come above. But here sometimes this can become internal liquidity. But when you look at why should the markets come back here, there are no imbalances, there are no any place for the market to actually react from, like maybe close. What's the word again? Like what's the word again? Forgetting this. But there's no place for the market to react above here, right? All the imbalances are actually reacted from. It pulled back. This was maybe last possible place. So institutional candle and other few points that are reacting at the demand supply place here, right? The market reacted, they created this imbalance.
Filled up.
Yeah, they've all been filled up here. Now, this is the only imbalance. And then the market came back, reacted from that particular place, broke structure again, reacted from this imbalance here, right? And then broke structure again, did not come back, and then it created the mini structure. Now, look at what happened here. The market became bullish immediately it broke this point, right? So it did not come back. Then made a higher high, higher low, higher high. Let's zoom in because the structure there is becoming interesting. High, higher low, higher high, higher low, right? Higher high, then broke structure here. You can see that. Right? So now this becomes the trading range. This is the trading range, right? That's the top range, and then this is the down range, right? And as you can see, the market has traded back to the trading range premium zone, right? Because if you put your Fibonacci retracement zone now, from the tip here to the tip here, this is more like above 50%. This is your 50%, and this is 786 here, and all the way to even 90 something percent. So this is very good retracement into the premium zone. Now, if you look again, you can see this XABCD pattern, X, A, B, C, D, and then the market reacted. See the strong reaction the market gave from here. So now, if you go down to 4 hour, let's start with 8 hours. The market have retraced. Now, look at what happened now. Can you see what happened in 8 hours? This is the daily range trend. But then 8 hours changed, right? And became bullish and has kept respecting that trend, right? Broke structure here, came back to this imbalance. and then reacted from this imbalance. Broke structure here, came back from this demand supply zone here. Can you see that? And then it has broken structure. So it's still bullish on the 8 hours, right? Now let's check 4 hours. So if you are trading for 8 hours, you can see that you've not gotten a sell in 8 hours. I don't know if you can see now, right? Now let's check from 4 hours. Now, bullish retracements, bullish retracement. See, 4 hours is also what? Bullish, right?
Bullish.
Now, how should you not trade this guy now? You can only trade this guy from these 4 hours if you are not using the 24 hours, which is daily trade. Maybe enter anywhere around there, put your stop loss above the daily high. You have to wait for this guy to break back to be in sync with your daily time frame. Right?
Daily time frame.
Yes. So daily is bearish, but these lower time frames are not bearish. So you have to wait for them to become bearish by closing below these points here. Right? So yeah, that's that about volatility 75. And then let's see if we can see anything on Boom 300. I think Boom 300 was my favorite. Then, sorry, and the 600.
How are you?
Eh?
I don't know why I don't like Boom.
You don't like Boom? The only beautiful thing about volatility 75 is that the stop loss can be small, and I think it's the one that has the least stop loss. What I don't like is the step indices. I only trade step 25 then, but the other steps, their stop losses are usually big if I calculate it. So I don't trade. It was only 75, then step 25, Boom 300, and I think one of the crashes, I don't remember either of the crashes that I was trading down, but yeah, was I trade 10. Sorry?
How about 75 one X?
75 1S is still okay. The stop loss is not big.
Okay.
Do you know how to calculate the stop loss, your position there?
Synthetic, no.
Yeah. Okay, I'll send you something for that. I'll send you something. 10, 1. Most of the 1S, their stop losses are small, right? Because 1S is just like, what's it called? More like, I would like to say, imitation of the other index, right? So which other one do you say you want us to look at? Let's see. You're making me, I'm making me
75 one X.
75 1S. $75 1X. Okay. Let's go to 24 hours. Okay, 1 day, not applicable. Let's see this guy, 24 hours. Now, the interesting thing I can see on 24 hours is that this guy is bullish. I don't know if you can see it, but that's what I can see here.
Okay.
This guy is bullish. So can we talk about how he's zoomed in? You're not even now that I zoomed in. If you take what we zoomed in into, it is bearish, right? Because looking at what we zoomed in, this is a high here, this is a low, right? So the market broke structure somewhere around here, but then this whole thing is still the swing high because this is where the market retraced. So this, if you consider this whole thing, this is your high, higher low, higher high for this whole structure. The market broke structure and became bearish, considering all the data we are seeing here, right?
Okay.
And then you expect the market to pull back. Now, if the market should pull back to make a lower high, right? Maybe because we don't know what the weekly time frame is in because we don't have access to weekly time frame data, right? Then considering what we are seeing here, if the market is pulling back to make a lower high, then this is the beginning of the move to make that lower high. How do we know? Now, if we zoom in, right? We zoom in, we can see something. We can see something here. Let me zoom I see something here. The market has just been selling, and then it came down to this place. It made this low here. It pulled back like it did in that Solana with all these hammer, whatever, spinning top candles here, right? And then made another lower low. This low is lower than this one, right? So invariably, this lower low was bet by this guy. This is the high that betted this low now. Abi? So invariably, this became a structure point, and this is another structure point. Now these moves broke above these points, so making this daily time frame now to have changed towards bullish, and this may possibly be the move that is starting that retracement from that whole swing that we saw. We never can tell, right? And these are those kind of trades that you patch and you could hold for a whole long period of time. Okay. So that's that about this guy. So how will I trade this guy? Maybe go to 8 hours, and then let's see what it is. 8 hours, of course, we bullish, right? So this is what 8 hours has in stock for us. 8 hours may not come in. Now, this is what 8 hours has in stock for us. See, low, lower high, lower low, lower high, lower low. So the market broke above that point here, right? So this whole thing is a swing point, right? Look at this imbalance here, around 6,000, 6,100 zone, and then it's actually coinciding with this support resistance points. So it's a very good area to consider for a buy or sell, as the case may be. So how will I trade this now? How I will trade this now with the two ways. Either this way, right? But if I trade it this way, the stop loss is big. I don't know if you get. So I may trade it. So it's just that risk that we are always actually open to. Now I may trade it this way, but trading it this way is still very risky, right? So I'll have to wait for the market to trade back into this zone, right? The market comes back into the zone you've marked out now, and then do funny things here. So you wait for the market to do very break structure, right? And then you want to get in this next pullback. To make your stop loss smaller, you can get in that next pullback, something like this, anywhere here. Now your stop loss should be something like this. And then you shoot for that previous high. 1 to 3 is a very good something. That's what we always aim for. If it's less than 1 to 3, we are not interested, right? So you shoot for 1 to 3. And then if you consider other structure points you are seeing, support, possible areas where resistance can actually come into the market, or possible areas that support can come if you're actually selling. And it's giving you that vibe that, oh, this market will be resisted here. It may not have that smooth ride that I want. So it should be another reason for you not to take that trade. Okay. You just want to mark it out, look at it as per your studies. Remember, the whole goal is to make money and not to lose money. So that's that about how I would have traded this 75 1S. I don't know if you have another question, another pair you want us to look at.
Okay, I was going to talk about entry. Because the challenge I have most entry.
Okay, entries.
This example we just I think in a way
okay, entry. Yeah, I'm coming. Let me plug my PC.
Mentorship by Sunny entries. Talked about 1, 2, 3 entry pattern. It's quite different from the 1, 2, 3 you mentioned. So that 1, 2, 3.
Okay.
If you look at where you have this ranging, where you have this ranging market now.
Yeah.
You discover that the 1, 2, 3 had played there. Yes, around there. Yes.
Okay, that's harmonic 1, 2, 3.
Now come again.
Is it harmonic 1, 2, 3? The 1, 2, 3 that goes with a drive, something like this. Let me show you. Okay, this 3 drive pattern, something like this. So you buy here. So you buy at this last one. This is the first drive, second drive, the third drive, and then you buy at this one. Is it?
Okay, no, not this one, not the amount.
How is the
that
one?
That one is just. It's more like head and shoulder.
Okay, head and shoulder.
So you have the first drive, you have a BOS, and you have the second drive, and then it breaks structure and comes down to FVG.
Okay.
Look at the ranging market there. You see. Yeah.
Inside here, right? Inside here.
The longest leg. He came back and took.
After this, right?
The protected low. Immediately after the protected low.
Okay. The protected low. This is the protected low.
Okay. Then the next leg.
Here.
Yes. That's what I was meant to understand. Entry.
That's where you would have entered.
Setup. Yes. That's what I was taught.
Okay. So yeah.
So the challenge I had is,
I think that's not bad either. Okay. So what I think is the problem is not really, I think it's marking out your structure points, right? Because if you're not able to mark out your structure points, you won't know where you should actually enter. I don't know if you get. Now, these are your structure points here. On this time frame, this was the last low you had, right? So the last low you had here, and then the break of structure happened here, right? It broke here, and you saw a buy that came up. This is a high. This high was protected. It was respected, right? Because this high did not break above the high. So this became your lower high here. I don't know if you get. And this lower high brought about this low here. Okay? Right? This lower high brought about this low here. So now, where was the last body close for that guy? If you're marking the structure point properly. The last body close. This is the last body close. Right? This is the last body close. Right? And then this last body close, in this very time frame that we are at, this guy did not close above it.
Okay.
Remembering that we are marking our break of structure with body close, right? This guy did not close above it. But yet, it still played out as if that, okay, this was a break of structure, retracement, and then go. Because if you do that always, there are places it will not work that way. If it doesn't break up, it can fail you. So the reason why I would not trade this point is because this point was not a structure point. So if I'm marking a break of structure, I'll mark from this low. But if I trade this point, it means now that this very point here is becoming the new higher low and no longer this low here. I don't know if you get. So that is why in cases like this where there is debating points of entry, you can mark out the possible points of entry that you think will play out, right? And then you look at the first point. If the market comes there and gives you the opportunity to enter, just like it did mark out in that setup you sent me, you said you refine the entry in lower time frame. You do that same thing. But how do you do that now? What you do now is that when you come to that box area, you look for the market to trade to that zone, it should be, if it's a buy, it should have been coming with bearish trend, right? Something like this. So you want it to now break structure to change to what bullish, which is this, right? If it does this, if you're comfortable with executing at markets, what's it called? Markets buy and then placing your stop loss below this point, is okay. Remember that this new move now is now in sync with that higher time frame that you did your analysis. You get now, right? So now it's not in sync with that higher time frame you did the analysis off of. So you can now comfortably place your stop loss here. If you get 1 to 3 speedily, because the stop loss is small now, Navi. If you get 1 to 3 speedily, is okay. And then you can decide to get out of the trade. If you get 1 to 3 speedily, you can decide to take maybe 80% of your position off, right? Now take profit of 80%. Especially when you have loss. You say, for instance, now, like me, I had a loss yesterday now. I woke up today and I saw that my XRP trade that got stop loss and I lost some money, right? So the next trade I will get now will be to recover my loss, right? So if the trade starts going as I predicted, I get maybe 1 to 3. I will close at 1 to 3. I wouldn't even want to ride the whole trade to see if it will get to 1 to 5, 1 to 10. 1 to 3 is okay for me. I've recovered my loss. At that 1 to 3, I've recovered my loss, and I will have 2 profits. Yeah, because what I reached the other time was 1, and this thing I've made 3. So 3 minus 1 is 2. Now, so I'll be left with 2. That's how I manage that trade. Yes. Let's say, for instance, I reached $10 in the other trade that I lost. So I lost $10, Abby. And on the new trade I'm taking now, if I win it 1 to 3, that's $30. So 30 minus 10 is 20. So I'm up $20. That's where I will close. But if my account is okay, it's positive, I'm running fine, I've not made any loss, nothing is happening, I could just come to that first 1 to 3. I'll take off 70% or 75%, and I'll take my stop loss to N3 to the point where I had entered before, and then I'll leave the rest to run. I don't have anything to actually lose again. So if the market decides to come back to the N3, I've taken something off, right? The market keeps going, I'll keep earning on it and earning on it. So that's basically how I manage my trades when these trades are in position and running. Okay, I don't know if you have another question.
For now, I wanted to ask why so comfortable that the trade will always come back better. Explain. This is where the break of market shift in market structure. That's change of character. So so it will always come down to fill up the FVGs.
Not just a case of FVGs, fair value gas and whatever. Okay. Now I will say from experience, right? We've learned a lot of things in the course of trying to be a good trader, right? We've learned that many concepts, fair value gap, imbalances, liquidity, all those stuff, SMC, BTMM, or whatever. What I've come to see is that the summary of everything that happens in the market is this. This is the summary of everything that happens in the markets. Oh, okay. Let me use this. If a market expands in a bullish market, it will always come back, retrace, to expand, retrace, to expand. Now, when it's made this high, it has lost momentum. People may be skeptical to buy again. So now, it can come to the nearest support or nearest whatever, and you start looking for, okay, is the market retracing? Where is the likely areas where the market should come to if it retraces? Now, you can start calling your fair value gap, your imbalances, points where there will be the need for the market to actually come out of losses. I've forgotten the term they gave that one. Mitigation points, whatever you want to say, or whatever reason you want to give for the market to come down, but also that the market to do what? Retrace. And to not stress yourself so much about all these things, right? Lots of Fibonacci retracement too. On average,
Okay.
Fibonacci retracement is a very strong, it occurs even in nature. Even in nature, there are Fibonacci patterns everywhere, right? Flowers exhibit Fibonacci patterns, and so it works, right? It works even with price action. So now you ask yourself, when now this market can come back to at least 50%, right? Of the whole move, the previous move. Are you okay entering at 50%? If the stop loss is too big for you to enter 50%, then you have to forget about 50%. So where's the next point? The next point is 60%, 618, right? 78%. So you look at it, then you look towards your left, right? The left is the previous price actions. What has happened in the past? You look towards your left, what's happening? Where can the market find support across all these Fibonacci retracement tools? The market will most likely find support, so one of them, right? So if your support is coinciding, so in summary, it means if your support now is coinciding with one of these levels, maybe 786, then it's most likely for you to expect the market to drop to the zones of 786. And remember, support in the market is not a price level, it's a zone, right? Because if you mark your resistance somewhere here, right, you see that this guy came all the way here, this one reacted here, this one reacted here. It's not a specific price level, it's a zone, right? So now, what will I do next? Having marked my support, I will look for quarter points. That is whole number prices. That's okay. What are the nearest whole number prices around 786? I have 5,984. 5,980 will be below, and then 5,990 will be above. 6,000 is not so far from 786. Am I comfortable entering at 6,000? What is the risk like? That's the next question I'll ask myself. Where is 6,000? Am I comfortable at entering at 6,000? But that's a very good quarter points, right? So that's I'll ask myself, check the risk. Risk is 2 point something. Okay, I think I can do that. Then I'll play 6,000. If I can't play 6,000, I would want to play 5,990, right? If I can't play 5,990, I want to play 5,980, right? So, but then if I have skepticism that, okay, 5,980 is going to be played though, right? And I don't want to miss out. If the market decides to come and do 5,981, I don't know if you get. So I'll not stop playing 5,980 per se. I'll not play 5,982. So if the market comes and trigger me at 5,982, I'm good. If it drops all the way to 5,980, I'm good. If it drops all the way to 5,990, we are in, and then the market can rise. So the only thing it will happen is that it will affect the position size that I would have taken, because at this point in time, if I enter here, let's say if I enter at 6,000, and I'm risking $10 with that same account size or that same position size, I enter here, my risk can drop to $5, right? Because this piece has been halved, right? So that's about entries, about calculating your risk. Your risk is actually shown not by your position size, but by your entry and your exits. And remember that there are two most important things in the market for a trader. Those important points are exits. Exits are more important than your entries, even for people who do venture capital and institutional investments. They will always look at what is the propensity that this guy can do 3x in 5 years, or this guy can do 5x in 5 years. If the exit is not looking promising, most persons don't want to invest in that business. Most persons don't want to be part of that venture round, right? So exits are most important than even entry. Now, exits are two. Exits can be your stop loss or your take profit, nothing else. Your stop loss or your take profit. So if you have clearly defined those points, okay, if it gets so bad, this is where I'm getting out. This is what I can actually take as a loss. If it gets so good, okay, we'll start taking profit from these particular points. These are the points of exit in the market. You define these, you keep them down. And if you're okay with the risk, you take it. If you're not okay with the risk, you can just mark up the trade, leave it there, and then maybe when the trade plays out, fine, you come and look at it. It will still strengthen your confidence, right? Because remember, not even trading is a trade. It's a very good signal. It's a strategy. You don't have to trade everything that comes or moves across the market. You have to only trade the ones that meets your required setup, risk management, and everything. Okay, so that's about this guy. So I don't know if you have another question.
No, for now, let me go through all we have, and then do the assignment.
That's beautiful. And I also want to ask, are there any key takeaways? Like, do you think you actually got some value for spending time on the score?
Yes, I would start by saying one of the mistakes I made earlier was listening of and that has brought confusion.
Okay. Sorry?
Can you hear me?
You're not that audible.
How about now?
Yeah, I can hear you now.
Okay, I've especially on YouTube, so having a lot of junks on YouTube has caused confusion my way. So what has really changed? One of the things that really changed the perspective at which I look at the market is the higher time top-down analysis. Now, from what I've learned now, it's clear that the higher time frame direction movement determines the lower time frame, and at most times the lower time frame can be counter trending, which is something I've always known. But what has made the difference is that there was always a time when the lower time frame will always synchronize with the higher time frame, which makes it beautiful. Now I've always seen people trade the counter trade, which have not been very okay, because most times when I've tried it, I have lost out. But from what I've learned today, there is a possibility if you really know what you're doing, and then at least know where to exit. And okay, this first is one of the things. And secondly, the entry issue has been a challenge to me. And like what I stated, most times I want to jump into the markets that first time. Then later, if I successfully go in, I later find out that the market will trace back and take me out. So maybe by that time I had trading forex, I opened some other lots, opened some other positions as the market moves. So when the market begins to retrace, it takes me out. And this is basically one of the reasons why I get wiped out. So from what I've learned here now, having like you stated, apart from the imbalance to come down, because the break of structure is the determinant. That's the shift in market structure, which we call choke. So definitely it will come to fill up this imbalance. And then one of the things that attract it is that I have to make sure I recognize where we have the zone of support and resistance. So from there I can now start doing my bit. So that's it.
Yes, that's okay. That's I think that's a lot. That's a lot to have taken from here. And again, always make use of your Fibonacci retracement. Yes, always make use of it. And the beautiful thing about all you've learned so far is that they were not waste of time per se, because I won't say that I just make my analysis by virtue of price action. I just make my analysis by virtue of technical indicators or whatever. Whenever these things build or confluence, they increase the possibility of the truth. Let's say, for instance, that I did some analysis. Okay, now, what does the knowledge of price action tell me whenever I'm making analysis? If I look at this guy here now, right, and then having seen this guy here, I want to definitely look at my left-hand side to see if we are at the support level. Because I'll ask, this guy was big, this guy was big. Why are the candles here now printing small? I know when the candles are printing small, you're showing exhaustion, right? You're showing lack of conviction. And the market is not convinced that the market should still keep selling here. That is what this personal candles actually say in when you talk about price action, right? Then I want to look to my left hand side to see what is happening. Why is the market doing that? That's for price action. Now, if for technical indicators, definitely at some point you want to say, okay, maybe I'm seeing this what's it called now? These three dots patterns here. Let's say that I saw this now, I saw this, I saw this, I saw this, then I saw this, right? And I want to know if I should buy at these particular points, right? This particular points here. I'm feeling like, oh, the market can buy here, but I'm not confident enough to buy here, right? What can I do next? I can just open up a technical indicator, like maybe MACD, MACD, moving average convergence divergence, and I will check for what's it called? I'll check for divergence here. Now, what can you see here? I don't know if you can see these points now. We are in the market. Let's mark it out to show you how all the predictions we run so far can actually come. Now, you see these points here. This is a moving average convergence divergence. What's happening? These are 2 points in the market, right? If you check here now, the market made a lower. Okay, let's just compare these lows here, right? The market made a lower low here, and ordinarily you should have expected the moving average convergence divergence to make a lower low too, right? That's the ideal expectation for the moving average divergence convergence. But what happened? The moving average divergence convergence made a higher low instead of a lower low, which is showing you that there's a crack in correlation between the moving averages and the price action, which is another confirmation for me to say, okay, maybe that my XABCD pattern can actually work here, because this guy is showing what exhaustion, right? That's about bringing together all your plans, find a way to sync all of them and make them be an opportunity for you to make a very good informed decision in the market, not throwing anyone away, but seeing how you can put this in, put that in, put that in, and then build a very strong arsenal. Okay?
Yeah.
Okay, so that's that about this. So thanks for hopping on the call. I think we've exhausted what we have for today. If you don't have any questions, that should be the end of the call for today. And if you have questions, or you have any particular pair you want us to look at again, maybe crypto or anything.
You sent me the first walk you sent me on Solana.
Yeah.
First picture you sent me. I was actually wondering why he had to retrace to that point of interest for the second time. After the break of structure, there was a retracement, and it went away.
Okay, so let's open up Solana.
And then he retraced back again, and that's where it entered. So it took me like 3 days to look at that on Solana.
Okay, was it the first buy I took?
Yeah, the first sale took with the first picture after you asked me to send my work to you.
Okay, that should be somewhere around there now.
Yes, you are there.
Yeah, somewhere around there.
Yeah.
Okay,
the second one.
Okay, so this is it now.
After the next retracement.
This is the
You're right.
The daily is bearish here. Okay, this is where the daily became bearish. This whole thing now is going to retrace somewhere into the daily, and he didn't give it us, and then he broke here. Now, once this guy broke here on the daily, remember we are working off the daily. This is the daily. This is where we are working off. So this is the daily structure points, right? Let me mark that out. And then these are the daily structure points, right? So now, like I said, the daily broke here, right? And I expect this guy to retrace. So because it's a lower high, lower low. I expect it to make another word, lower high to continue to be very strong. So retracement must definitely occur. So the question now becomes, where should I enter, right? Now I'm looking at stuff like, okay, this is where the market had been resisting, right? Okay, so that's happening within that zone. So I'll go down to 4 hours. Okay, 4 hours. Now observe something, the same thing we discussed. Observe that when this, observe that when this, can you hear me now? Hello, can you hear me, Mr. Chris?
Yeah, I'm hearing you.
Okay, so now observe something. Now remember, the daily is bearish, right? And this is our daily range. From this top to this low is our daily range. Now see now what happened here. We are waiting for the daily to retrace, and then we want to sell in the daily. Now look at this market came here, made a low, made a lower low, a lower high rather, made a lower low, and then broke above it. Became what? Bullish in the 4 hours, which is marking the beginning of that daily retracement, and not that the market had become bullish. After this first this thing, the market retraced, right? Did this, retraced again, did this, retraced again, did this, and then started selling. So me, I was looking to sell at 240. I think I sold at 240 or 241. I think it should be 240. And then my stop loss somewhere above, 245 or so, just above this very high. That is the point I know that I think that the market should want to protect. And then the market played that out and sold. So also when the markets, after breaking this low, the market pulled back again and sold. So oftentimes, before it happens in the higher time frame, it will happen in the lower time frame, right? If the daily is retracing, the 4 hours is bullish, the 4 hours is retracing, the 1 hour or 45 minutes or 30 minutes should be bullish. That was what I traded on this particular zone. Interestingly, I did not even see that there was a head and shoulders pattern here. I just saw it now that I mentioned this because I don't really trade this kind of patterns again. So yeah, this is now I saw it. Yeah. So that was why I made that trade, and that was the thought process around that trade. I think that's all for now. So yeah, maybe next time then. Have a wonderful day, and thanks for making our time to be on the call.
I appreciate your time.
Yeah, thank you so much. Enjoy the rest of your day.
Thank you.
You're welcome.
You too.
Okay.